Hello, and welcome to another edition of the Up Your Assets podcast. I'm your host, Ray Ferrara, CFP, founder and executive chair of Provise Management Group, with offices in Clearwater and Tampa, Florida. When people hear the terms financial planner or wealth management, they often assume we simply manage investments, and nothing could be further from the truth. But investment management is certainly an important part of what we do. We manage about $2 billion for approximately 1,200 families across more than 30 states. But as certified financial planners, we believe a written financial plan that defines your hopes, dreams, and aspirations allows us to do more than just manage your money. It helps us understand your goals and to serve you more effectively. In my 55 years of financial planning, I've seen markets rise and fall. What experience has taught me, though, is that over time, they keep moving forward. I often compare the stock market to someone walking up a flight of stairs while holding a yo-yo. Many people focus on the yo-yo as it moves up and down, but overlook the steady progress going up the stairs. From the high inflation and interest rates of the 70s to the real estate and oil and gas downturns of the 80s, the dot-com boom and bust of the 90s, the financial crisis of the late 2000s, the volatility of 2015, COVID in the early 2020s, and all the challenges we face today, the long-term direction of the markets has remained forward and upward. To help us unpack the world of investment management, I'm pleased to welcome Kara Murphy, CFA. She is the Chief Investment Officer of Kestra Investment Management, where she leads the investment strategy, market research, and portfolio construction for Kestra financial professionals. Since joining Kestra in 2021, she's brought more than 25 years of experience, including prior CIO roles at Goldman Sachs Personal Financial Management and AIG Funds. At Kestra, Kara oversees investment solutions, market commentary, and tailored portfolio management services for Kestra Holdings companies, with a strong focus on asset allocation, portfolio construction, and multi-manager model portfolios. In 2024, she was named Chief Investment Officer of the Year in the Markets Media Group Women in Finance U.S. Awards, and she's a frequent contributor to major media outlets. For full disclosure, Provise is affiliated with Kestra. As with all of our guests, however, Kestra has not paid to appear on the show. We're honored to have one of the country's leading investment professionals with us today to discuss the markets. Kara, welcome to Up Your Assets.
Thank you, Ray. I appreciate you having me.
Well, it's a pleasure to have you, and there's so much for us to talk about today.
Always.
There always is in the markets, as I just outlined. You go through all of those decades, and there's just lots of stuff going on, much more than I mentioned. Well, you've worked in the investment world for about 30 years, and with some very impressive companies. What brought you to Kestra in the first place?
So, as you mentioned, I've had more than a few bear markets in my career, and I've had the great fortune to work at a number of really large companies where I learned a ton, and it was a wonderful place to spend earlier in my career. But as I got to know Kestra, the ability to be in a very entrepreneurially minded, very growth minded atmosphere, one that was very focused on serving advisors and their clients, ended up being too much to resist. I really enjoy partnering closely with you and your peers to think about how we can help you serve your clients better, grow your businesses. And Kestra was really a place where I was able to do that, have an important impact.
Well, you certainly have done it in a short period of time, and congratulations to you and your team. Just read an email. You reached your 5-year goal in 4 years and now managing $5 billion on behalf of
Yeah, we're
customers.
excited. We're excited. But you know what? Like more than anything, more than that number, what that means to me is that we're able to build trust with you and clients and whatnot and be able to support folks as they get, on the way to their financial dreams. And that's really what motivates us every day to get up.
Oh, I couldn't agree with you more on that part. Well, when you talk to advisors and their clients about investing, what's the most important thing to you, and how does it influence the decisions that you make?
I spent a lot of my career in this business on the asset management side. So I was a stock picker, I worked at a hedge fund and other large organizations. And I spent so much time just focused on, okay, is this stock going to go up? When I started working with financial advisors and their clients, there was this big realization that, like, oh goodness, like the risk that clients are taking on, how this particular position interacts with other ones that a client may own is so important to help get a client to whatever that goal might be, right? Understanding what the path might be, how long you have, those become very, very important in the decision. And then how the different pieces of a portfolio react to each other becomes much more important than any one single position.
No question about that, and diversification is the key. It's said that the asset allocation piece, that 90% of the returns are generated exactly by what you were talking about, the asset allocation within a portfolio, and then sticking to a discipline of rebalancing. Uh,
100%.
you're agreeing with this philosophy, and curiosity, how often do you prefer to rebalance the portfolios you're managing?
So, one of our core values is being very disciplined. So, we want to make sure that we have a playbook for all different market conditions. That way, when the market starts to go kablooey, we're not like starting that work. We have that playback that we can turn to, and a lot of times we'll have to tweak it based on market conditions. Now, that said, as part of that work that we've done, we've looked at a lot of different market cycles to try and identify what the ideal process for rebalancing is. And for folks who might not be familiar, the idea is if you think about on a very simplistic level, you have a portfolio that's half stocks, half bonds. The stock market does really well, and then all of a sudden, stocks are a bigger part of it. Rebalancing, you bring those two things back into alignment. And it can often be very difficult to do that when markets are really bouncing around. But that's why having that playbook kind of ready to go is extraordinarily important. The interesting thing is what we found is that there's no ideal period under which to rebalance. The important thing is to be consistent. And that's why every market is sort of different in its own way, and what assets lead, how quickly stocks recover. But approaching everyone with this very consistent mindset is ultimately what leads to better returns over the long term.
Um, I've often, I'm going to keep your simplistic approach with half bonds, half stocks, and those go up, and you're going to buy what went down, at least on a relative basis. So I've teased a little bit. You have to sell your winners and buy your
Yep.
losers, because at
Yep.
some point your losers are going to become your winners, and that's what you want to keep doing. And in most portfolios, you're going to have more than just stocks and bonds. You're going to have large cap, small cap, mid cap, international, domestic. You're going to have different types of bonds that'll be in the portfolio, and perhaps some alternatives like real estate that'll be in there. And so it's a delicate balance moving all of those around. And if you move them too often, you're you're going to miss some of the fast acceleration. As an example, as we've
Yeah.
seen here in March and April of 2026, how quickly the markets can move.
Well, and it's interesting because we've actually had 3 very, very quick cycles, right? You go back to COVID, that was one of the sharpest, biggest downturns that we've ever seen in the market. If you waited too long to rebalance, you missed it. Then we had the 2022 bear market. That was a more like slow and steady sort of downturn. But then we had tariffs last year, right? Very quick downturn and swift rebound. And then this year again. So this is just, in a period of 5, 6 years, you've had 3 really big market drops and recoveries, and then another one that took a lot more time. So, it's sort of having something that works in all those different environments is really important because you never know which one that you're headed into.
So, Kara, you set it up perfect for the next question. The client says, "Well, Ray, Kara, well, why don't you sell at the top, and then when the market goes back down, buy at the bottom, and then that way I wouldn't lose all of that money." Sounds really simple. Want to tell us why it doesn't work?
Yeah, well, I'll show you because just for those sorts of questions, I have my little crystal ball right here, and I was really hopeful when I got it as a gift that I would be able to tell the future, but it doesn't work. And if you imagine, so there are like millions of people like me sitting at their desks, staring at the same data, the same stock charts that I am, trying to identify when that high is going to go back down. But if you have millions of really smart people, really dedicated, trying to figure that out, they're naturally going to kind of compete these things away. And nobody can do it because the market and the economy are just way, way too complex. So we can identify times when we should be starting to like take some chips off the table, right? So that might be like downshift your portfolio a little bit, but we never want to just exit the market because it's impossible to determine from one day to the next where the market is going to go.
Kara, kind of tying in with that, I've noticed on our news channels, those related to the market, that there's a lot of people who say, "Go to my website. I'm going to give you the single best idea you've ever heard of, and you follow my system." I won't name names, but you know the commercials I'm talking about.
I sure do. I have one going on my TV right now.
And what amazes me about that is that if everybody followed whatever that model was, there simply wouldn't be a market.
It wouldn't work. Yeah, totally.
Uh,
Totally.
so timing doesn't work either. You can be right once, but being right twice in the markets, selling when it's high and buying when it's low, it's pretty hard to do, and particularly as things have been as volatile as they've been over the last few years.
It's just as important to think about not just like this particular investment that you have and how well that does, but how well is it interacting with everything else in your portfolio? And oh, by the way, how does that collection of investments then correlate with what you want to get out of it? Right. So those are the complicated pieces to it all. Like anybody can, you can get lucky, right, by picking something that goes up, but is it really doing what you need it to?
So secret sauces don't work either. I guess that's what we're both saying.
I'm deeply suspicious of secret sauces.
So right now, the market's pretty much at an all-time high. Haven't looked at in the last hour or two, but it's at or near its all-time high. I'm an investor. I've got a bunch of cash. Maybe I just inherited some money. Maybe I was lucky and won some money in the lottery. Maybe I just cashed out of selling something else, and I've got this cash. What do you advise people to do when everything's at a market high and I've got all of this cash and I don't want to jump in at the top?
Nobody does, right? But the thing to remember is that the market actually spends an awful lot of time at new highs. That term goes really well on a headline on CNBC. But if you think about it, the market's going up over time. And I love your analogy of the yo-yo on the staircase, right? It's a great idea. The market's going like this. It feels like it's going like this every day, but it's actually going like this, right? So even if you invest at a high in the market, given enough time, you'll be able to recover. So I think it's important. The biggest mistake that people tend to make is just not getting in the market at all. The biggest mistake is not necessarily buying at the top, right? So people have a tendency to hesitate for too long and then they miss opportunities.
Yeah, there's no question. And anytime somebody says, "I'm going to wait," it's my question is, wait until what?
Yeah,
Until
exactly.
when the market goes down, and then you're going to be more fearful of investing because it's going
Right.
down and maybe it'll go down further. So it goes right back to that timing situation.
Right.
Tech has really been leading the market ever since we first heard the words artificial intelligence or AI. Um, as you're looking and working with portfolios today, how are you thinking about this AI play that everybody's talking about? Is it overdone? Is it just right? Is it in the early beginnings? Give us your perception of what's going on there.
So, as you can imagine, this is an area that we're spending a lot of time on because AI has an incredibly important role within the broad economy, driving the market, and then also how we do work. Like everybody else, our team is really experimenting with different ways to incorporate AI into our daily workflows in order to get more out of our day. But if I could like sort of start from an economic perspective, because that's my background and that tends to be where I begin looking at things. Um, AI right now is basically absorbing most capital expenditures that are happening in the US today. About 1% of all GDP is in CapEx associated with artificial intelligence. I mean, it's remarkable, right? And over the next 12 months, we're talking about $1 trillion being spent to build out all the infrastructure that's needed to support AI. That alone tells you that you can't ignore this. This is here and it's going to have a really big impact. But to your question about is it overdone, underdone, just right? I think the long term impact of AI is still likely underappreciated, but the winners of AI are not always the ones that people are going to think they'll be. And so, one way that we've tried to think about this is by looking at previous technological revolutions. So, think about things like electricity, the car, railroads, personal computers. Each of these was a very different piece of technology that got introduced. And so, it had its own like specific way that it impacted workloads in the economy and whatnot. But each of those introductions shares some similar themes. One is that it consumes an enormous amount of capital expenditures like we're seeing today. And the initial winners are those companies that produce the new technology. So think Edison Electric, right? They were responsible for actually running the wires to like factories and homes and whatnot. But today, when you look at the S&P 500, it is not made up of electric companies. Today, the S&P 500 is made up of companies that use electricity. So over time, we expect to follow a similar sort of path with AI, where we'll move from those companies that are building the things that run AI to folks who are building out the infrastructure for AI. But eventually it will move out to the users of AI who has figured out how to use this new technology to do more, better, faster. And that's really the lasting part of the impact of AI.
I've never heard it structured that way. It's really kind of fascinating to think about it. It's maybe the early adopters, if you will, are the big splash in the pan, but at the end of the day, the sustaining growth is somewhere down the road. There's a with that technology that you were talking about and the data centers that are being built. One of the things that amazes me is everybody's talking about how it's driving up the cost of electricity. And nobody, or hardly anybody, although it's just now starting to come into being a discussion, is talking about the vast water resources that
Yes.
are needed to take care of all of the keeping things cool and
Yeah.
processing everything. Somewhere along the line, I read that it took a quart of water for every question that AI answers. And I thought to myself, wow, and how many days, how many times a day, just Claude or
Yeah.
just ChatGPT or Grok or it's just amazing how much water ends up getting used by the whole thing. And I wonder whether you think there's any value on that side of the equation that people can take advantage of.
So it's hard from an investment perspective to benefit from water because often in the public domain, I live here in Texas where like water rights are a really big issue. And in fact, there have been some local communities that have started to push back against these data centers being built because you have residents who are kind of fighting for water. But I think it brings up a really interesting piece because you mentioned power as well. These are two resources that are limited in certain ways. Costs have been driving up and it's not available at infinity. And as these AI engines are getting better, they're using more of these resources. So today, there's an assumption that as these AI engines get better, that the resource consumption sort of tracks on the same pace. But there is another piece to this, and there are other AI engines that are actually more efficient in the amount of power that they use. So if you remember, DeepSeek was introduced. It was a Chinese-made AI engine. It's still around. It was a little over a year ago that it got introduced and really kind of spooked some of the other AI names. But its real specialty was not that it was a better AI engine, but it was much more efficient. So it sort of opened our eyes to the other piece of that equation. And I think ultimately the answer is not going to be bigger and bigger engines that use more and more power and water, but getting those engines more efficient. And that's kind of the next frontier that we haven't quite yet seen.
How are you on a day-to-day basis using artificial intelligence to help you manage the portfolios? And what are the pitfalls that exist in relying on the answers to the prompts from AI, since occasionally they do still hallucinate?
Yes, and it is a really big challenge. And so, it's interesting because I think we, like many firms across the world, really are still very much in the experimentation phase. So, what we've started with our particular investment team, we've started a list of all of the different AI related projects that individuals are working on. And so, it can be everything from writing investment commentary that we send out to you and your clients to kind of talk about what's happening in the portfolios, to analyzing risk levels within the portfolios, doing research on different investment items, gathering data. But to your point, like you can't put something in, get it out from the AI chatbot or whatever you're using, and then like go, right? You have to constantly check everything that comes back. And so it becomes this very iterative conversation where you're constantly asking questions, but then also asking it to justify or show you where it got that answer. And then you go and you verify.
So let's speculate for a moment. Does it become so universal that we don't need us anymore? We don't need you managing money. We don't need our advisors like myself. Um, Play out there
So
20 years. Where do you think it goes?
this is where I get kind of passionate, and I feel very fortunate to be doing what I do because I think as things become more automated and mechanized and there's more artificial in the intelligence, it makes the human element that much more important. AI can't replicate taste, judgment, trust, right? These are things that like you really need a person there for. And you in particular doing what you do, like you are the only one who can sit across the table, listen to your client, truly understand what's important to them, what they're worried about, and then be able to build something that they're going to have faith in that they can stick with. And that is really really critical. And I think this emotional piece of it too. I know people are sometimes using AI chatbots as sort of like relationship substitutes, but really nothing is going to change or supplant that person to person interaction. And in fact, I think they become more useful. And I'll give a quick example. So when we think about music, think about when Apple Music first came out on the scene. And it used to be like when I was a kid, you would go to the local record store, you might even line up when a new record was being released. You would collect them, you would trade them, you would record stuff off the radio, but it was really hard to get copies of music. Then Apple Music came in. We had some other, sort of other ways of getting music online, and that revolutionized it. All of a sudden, you could download a song with the click of a button, and then artists were only getting pennies, right, for each of those downloads. Well, what's happened today? We don't see less music being created. If anything, the cost of going to a music concert has gone up because the recorded music is pretty ubiquitous and isn't all that valuable. But going and experiencing that show, being there in person, seeing your favorite artist there on live is something that we will pay up for, right? So it only makes what you do even more important. 100%.
So, in your experience in working with so many financial advisors around the country, and your time at Goldman and at AIG, what's the biggest mistake that you hear or see retail investors making?
So I can say the biggest mistake with confidence and not just in my like personal experience in interacting with people, but the data supports this as well. The biggest mistake that people make is selling the market and not being invested. And it sounds so simple. Before we talked about why don't you just buy high, sell low? You can't. Nobody can predict the market's moves from day to day. So, the single most important way of ensuring that you are successful over the long term with your investments is staying invested in the market. And even though it sounds really simple, it's extraordinarily difficult for people to do. And again, right, like that's why it's so important what you do, getting people to understand why it's important, understanding the implications of not being invested. And as long as people do that, they're already cutting out a large sort of headwind that most investors have when they build a portfolio.
Probably
Yeah.
one of my most famous stories was early. early February, um, back at the time of the financial crisis, 2008, 2009. It was a Saturday morning. It was 7 o'clock my time. My cell phone rings. It's a couple in Texas that are clients, and they just think everything is going to hell in a handbasket. That we got to sell everything. And I can see the video still running in my head that morning, trying to convince them to stay in the market. But unfortunately, at the end of the day, their decision was to sell. And then to watch what happened over the intervening 6 months and the 25% rebound that occurred, then NA turned out to be a positive year before it was all over with. Not by much, but a little bit. And
Mhm.
so being invested and staying invested.
I'll share another quick story, which I always find so interesting. And it's with my grandfather, who was he was an accountant, so he really knew numbers very well. And we would get the bill after going out to dinner, and he would scrupulously like go and re-add up everything. He really knew his way around numbers, and we think he was also a spy. So this is a guy who could take risk and he knew numbers. That said, he had a small amount of investments in 1987 when the market took a nosedive, right? So, for folks who might not be familiar, this was at that time the largest one-day drop in the S&P 500, and it was like absolute pandemonium on the stock trading floor. And he tallied up his losses and he was furious. He was so mad. He felt like he was losing his life savings. He called his broker the next day, said, sell everything. 1987. If he had waited a year and a half, he would have recouped everything that he had lost. And then over the next 10 years was the best bull market of his lifetime. He did not own a single share during those 10 years.
Uh,
Like, what a loss,
Gee,
right?
yep.
And this is a guy who could take it, right? If anybody you would think would be able to take that type of risk and that type of volatility, like it should have been him, but he didn't have an advisor like you to help guide him along.
Yeah. So let's talk for a minute about private equity, private credit. Um, a lot of news about private credit not performing very well over the last 3-4 years. Private credit, is it really good credit? Is it bad credit? Um, how do you see those playing in most retail investors' portfolios? And do you feel like they're a safe place to go? And I bring this up particularly in light of the fact that right now there's a lot of discussion about moving what has traditionally been a place for knowledgeable investors and those with a lot of money to play, now being open to the general public, maybe in their 401k or other retirement plans. Do you see a place for those to work for what I'll refer to as the mass affluent individual?
Yeah, so like a couple thoughts there. One is that both private credit and private equity have grown substantially. Like if you think about the investing universe out there, it used to be largely dominated by public stocks, public bonds. But over the last decade, 2 decades, the private side has grown significantly. So you've seen a lot of dollars kind of move from the public markets to the private markets. That said, like I'm a big believer in it you don't have to have exposure to private assets in order to reliably grow your wealth over time. That said, some clients want to be able to access these other areas. So, if you have somebody who's very interested in it, the other thing I would caution people to think about is so if you look at different types of, let's say, stock managers on the public equity side, the range of outcomes is fairly tight. If you look at on the private side, there's a very large range of returns, meaning that there's a very different level of risk, different ability, different return streams once you move over to that private side. So, what that means is that if you want to put your own dollars in it, you have to be really careful about which of those managers you're going to choose. And it can be hard to predict which one's going to have better returns. So then to your specific question, like, is this a good thing for kind of like the mass affluent client to be able to get access to? Again, I don't think they need to. The stock market and the bond market has done an incredible job over 200 plus years growing people's wealth. But you can do it. Just be very, very mindful of the additional risk that you're taking in. Keep it small. Make sure that you understand the liquidity profile, the risks associated with it. And Ray, I'm sure you would be a really helpful guide in trying to identifying what's the right amount for each person.
So I refer to it as Las Vegas money. Um,
That's pretty straightforward.
Speaking of Las Vegas money, how about cryptocurrency?
Well, that I would for sure put that in the Las Vegas bucket. And by the way, I don't like gambling. I like the free drink I might get when I sit at a slot machine, but I hate gambling. And here's the thing, like I get asked about cryptocurrency all the time. And I am very hesitant to identify it as an asset class that investors should be in. That doesn't mean that it won't go up. It may very well go up, but I think the risks associated with it tend to be very underappreciated when that asset class is going up. I also think people don't really appreciate the level of volatility. So if you sort of like compare the volatility in crypto assets to a more common stock asset or bond asset, it's multiples, which means that it's moving around constantly. And so identifying when the right time to get in and out is extremely difficult and can be very, very painful if you get it wrong.
Well, my problem with crypto is I just don't know how to value what its worth is.
Me
It's
neither.
it's like art. The price is in the eye of the beholder, and the same is true with cryptocurrency. And there's a commercial out now. I think that is it the art that's valuable or the name on the canvas that's valuable?
Yeah.
I still
Yeah.
don't know the answer to that when
Yeah.
it comes to art.
Probably both.
Yeah, a little bit of both. Well, at the risk of you repeating something you said earlier, I still have this last question for you. What's the best piece of advice that you can give our listeners about long-term investing?
I gotta go with stay invested. Again, it sounds simplistic, but most investors actually can't do it. But if you can stay invested, your chances of success are extraordinarily high. And the longer you're able to do it, the higher your chance of being able to meet your financial goal.
Well, Kara, it's great to have you on Up Your Assets podcast. Get a chance to see you on Bloomberg and CNBC and some of the other media outlets, see you get quoted. Again, congratulations to you for the $5 billion
Thank you.
that you all have accumulated. And thank you so much for being on Up Your Assets.
I thank you. Have a good one.
You as well. Now, everybody, go out there and up your assets.
This has been another edition of the Up Your Assets podcast hosted by Ray Ferrara, CFP founder and executive chair of Provise Management Group, LLC. The preceding presentation was for general information purposes only and not personalized advice. Seek out a professional before making any financial decisions. Additionally, no guests pay to be on the show or are paid to be on the show. The opinions expressed are their own and not the host's or the show.